Hi there. In another video, and the links are in the comments, we've made the case for everyone to build themselves a dividend-paying portfolio as a way to generate passive income over a long period of time. In this video, we'd like to discuss two easy and effective ways we think this would be doable for the average person. Remember, it is our opinion that building a dividend income portfolio offers small investors a structured way to generate passive income while building wealth over time. For those starting out, choosing between investing in a selection of individual dividend stocks or opting for dividend-focused exchange-traded funds called ETFs. ETFs are like a mutual fund, sort of, and can be challenging in their own way, but do require less on the part of the investor. Each path offers unique benefits and considerations, and understanding these can help investors make informed decisions that align with their financial goals. Here's the part we all hate. But we have to ask, please like the video if you like the video, and we'd love for you to subscribe. Let's talk about building a portfolio with dividend stocks. A direct approach to building a dividend portfolio is to select individual stocks, focusing on reliable dividend payers, such as dividend aristocrats or kings, companies that have consistently increased dividends for decades. A selection of 10 to 20 well-chosen stocks from this group provides a degree of customization and control that ETFs cannot offer. For instance, investors can handpick companies with strong track records, such as Procter & Gamble, ticker symbol PG, Coca-Cola KO, which boast over 50 years of dividend increases and solid business fundamentals. When creating a portfolio of individual stocks, a small investor can tailor their choices to focus on sectors they believe will perform well over time or align with personal values. For example, excluding certain industries like pharmaceuticals or tobacco is easily achievable when directly selecting stocks. Here are some key benefits. First, dividend growth potential. Individual dividend aristocrats often increase dividends at a higher rate than ETFs, providing potential for rising income over time. Personalized control. Choosing specific companies allows for targeting industries or brands that investors trust and understand. Long-term stability. Many dividend aristocrats have proven resilient across economic cycles, making them stable options for income-oriented investors. As always, there are also drawbacks. Holding individual stocks means any downturn in one company could significantly impact the portfolio. Selecting, monitoring, and managing a diverse portfolio of individual stocks requires research and oversight. Investing in dividend ETFs is an alternative strategy that has some merit. For those seeking an easier, less time-intensive option, dividend-focused ETFs provide a streamlined way to access a diversified portfolio of dividend-paying stocks. ETFs like Invesco High Yield Equity, Dividend Achievers, ticker symbol PEY, or Schwab U.S. Dividend Equity, ETF, ticker symbol SCHD, include companies with high yields and reliable dividend histories, offering investors a low-maintenance option to gain exposure to dividend income, which means investors benefit from the professional curation of companies known for dividends, such as Chevron, ticker symbol CVX, PepsiCo PUP, and Procter & Gamble PG, often found in multiple ETFs. ETFs can also offer sector diversity, such as exposure to international markets with Vanguard, International High Dividend Yield ETF, ticker symbol VYMI. ETFs inherently spread investment across multiple companies, reducing the risk associated with any single stock's performance. Many dividend-focused ETFs prioritize stability, investing in stocks with low volatility, which can offer smoother returns. ETF investments are managed by professionals, allowing investors to gain dividend exposure without the need to track individual stocks actively. ETF dividends may grow at a slower pace than individual dividend aristocrats because ETFs prioritize stability and diversification over high dividend growth rates. ETFs charge management fees, which can eat into returns, although many ETFs keep expenses low, typically ranging from 0.1% to 0.5%. Let's talk about returns and dividend growth. The choice between individual stocks and ETFs often comes down to growth potential and convenience. Historically, individual dividend aristocrats, such as Procter & Gamble and Coca-Cola, have delivered annual dividend growth rates of 5 to 10%. In contrast, dividend-focused ETFs generally see dividend growth in the 3 to 7% range. While this difference may seem small, it compounds over time, potentially leading to higher income streams for investors who hold individual stocks and focus on dividend growth. However, ETFs offer smoother performance and eliminate the single company risk. According to financial analysts, ETFs offer an effective way for income-focused investors to diversify across sectors and geographies, as noted by Morningstar, making them a suitable choice for those looking to reduce risk while maintaining exposure to dividends. If stability and simplicity are priorities, a dividend-focused ETF like SCHD or SPHD may be suitable. Personally, we've preferred direct ownership, but admittedly, we do hold several ETFs to diversify the portfolio. In closing, small investors should evaluate their preferences for growth, income stability, and the level of involvement they wish to maintain in their portfolios. As Benjamin Graham once said, the individual investor should act consistently as an investor and not as a speculator. A reminder that the power of dividends and steady income lies in patience and consistency. Whether through ETFs or individual stocks, a well-structured dividend portfolio can be a reliable cornerstone for long-term wealth building. There may be decisions to make, but we'd beg you to not procrastinate. Start building your future now. Remember, this is just an opinion and is not intended to take the place of a professional. It's merely a jumping-off point for further discussion. Nothing we've said here is investment advice. It is for educational and entertainment purposes only. Seek the help of a properly registered investment professional before taking any action. This media may contain ideas we have adopted or not, as we see fit, and we may have positions and securities mentioned. Be well and prosper. Happy trails to you. See you on the flip side.